Okay, the market not looking particularly exciting, but there's been a lot of sideways trade recently. For those who are active in the market, should they be looking at consumer goods?
Not really. Some of our best picks are already overrun themselves. We have a Nestle, a neutral recommendation on Nestle now. We have a sell recommendation on Guinness. We're neutral on Nigerian breweries. We have a sell on Dangote Sugar. So across the board, I don't think the consumers are at their best periods now in terms of valuation. We think many of them are stretched.
All right, the brewers have been a firm favorite for investors in the market, particularly Guinness. Would you recommend that?
We have a sell recommendation on Guinness, and we've recommended Guinness several times on this program, but we think the price is stretched. The company is a great company. We think it's a company that can deliver sustainable PAT growth of 20% over the next 5-10 years. But at 245, we're not buyers. It's trading at about 23 times our 2012 PE, and we think it's rich at that price.
What about Nigerian breweries? They've got a major expansion strategy.
Yeah, we have a neutral rating on Nigerian breweries, and recently the shareholders of the company gave approval for the company to purchase 3 breweries, 2 from Sonar System and then 9 breweries, which make up about 2.9 million hectoliters, and effectively bring the company's capacity to 12 to 13 million hectoliters. Now, that is great news. The only thing is that we don't know anything about the pricing details, which would have been better for us to fit into our models and see the impact. But from a business perspective, we think it's good for 3 reasons. The first is that it gives it ready room to expand, and so you don't have to, the company doesn't have to undertake the lead time in which it takes to build new plants. The second thing is that Nigerian breweries was not in the lower tier of the market. Now, by effectively acquiring these companies, which are low-end companies, it has exposure to that end. And we think that end is going to account for most of the growth in the market. I think over the next 5 years, the low-tier end will account for about 35% of the growth in the market. Right. The third thing is that it has effectively removed the acquisition from the hands of SAB Miller. Now, should SAB Miller have gotten that company, then you would have had 3 major players in the market. Now, you still have 2, and Nigeria Breweries remains the clear leader in the market.
Sugar prices, they're falling. How's that going to impact on the sugar processors in the market?
We just have one big one in the market now, Dangote Sugar. And funny enough, buying Dangote Sugar is almost like a play on commodity prices, such that when commodity prices go up, you see margins fall because the company can't pass on the price increases to the consumers. And when prices fall, they record good margins. And so I think because sugar prices have been falling about 5% this year, sometime in Q2, you might see margins come up a bit. But I think concerning the sugar refining industry as a whole, I'm not really positive on dynamics of our industry. Sugar is a commodity and you can't differentiate it. And so there are low switching costs. And we're seeing competition coming into the market. Present utilization is about 60 to 70%. And you have likes of flour mills bringing in 450,000 metric tons in capacity. Olam International is bringing 250,000 metric tons. And so you're seeing an oversupply situation in the near future in the market where demand is growing about 6 to 7% a year.
Well, oversupply could be something that investors in the stocks are concerned about. It should be good news for the consumers at the retail level.
Yes, it is good news. Of course, lower prices are better for the consumer each time. But for investors, then you're worried if you're in an industry in which profit margins can only trend downwards.
Talk to us about flour mills regarding another issue, their rights issue.
Yes, we don't have details of that, but the company came out to the market to give indications that it will be holding a general meeting to get the consent of shareholders. I think it's a welcome development. At this time, debt ratios are not worrying, but they're about the highest in the market. I think from the company's projections, 2011 debt to EBITDA is about 2.4 times. And they addressed significant debt in the recent past. In December, the company raised about 37.5 billion naira through a bond issuance and about $143 million earlier this year for its sugar operations. And so reducing those debt levels we give, or debt to equity ratio, we give the market some comfort. But basically, we have a buy rating of flour mills at this time. I think something that most analysts have failed to consider in the valuation or consideration for flour mills is the cement business, and that's what worries us the most. That business accounts for about 22%, and it's an importation business mostly. It has operations in unison, but basically that affects just dividends. What is going to happen is that when you see Dangote and WAPCO bring on capacity, imports could just go out of the market. And then what happens to 22% of flour mills business? And so I think that is our worrying our concern for flour mills.
All right. Thanks so much for your inputs there and your insights. Seun Oyegunle, who's with ARM Investment Managers, talking to us from our studios in Nigeria.